while the financial headlines screamed that gold had finally peaked, with dramatic sell-offs dominating the business pages and major institutions dialing back their ambitious forecasts, the deeper currents in the precious metals market whispered a far more compelling story of resilience and untapped potential. Welcome to This Week in Focus, your essential Friday roundup, where we distill the most critical conversations and market shifts from the past 7 days into one comprehensive narrative. This marks our very first episode, crafted specifically for those who seek clarity amid the volatility of gold and silver. If this format resonates with you, share your thoughts in the comments below, because your feedback will directly shape how we evolve this series to serve the community even better. Let's dive straight into the heart of what unfolded. The week brought intense pressure on precious metals as gold prices briefly dipped below the significant $4,000 threshold on Wednesday, a level not seen since late last year. By Thursday, a determined recovery pushed values back above that mark, yet the overall picture showed gold down approximately 5% for the year so far. Silver faced even steeper challenges, trading near $58 amid the turbulence. These movements weren't random. They stemmed from a potent mix of macroeconomic signals that rattled investor confidence and reshaped expectations across global markets. At the core of the sell-off lay fresh government data on inflation, revealing that the cost of living had accelerated to its quickest pace in 3 years, registering at 1%. This unexpected uptick prompted widespread speculation that monetary policymakers might opt for interest rate increases rather than the anticipated reductions. Market tools tracking these probabilities reflected the shift dramatically, with odds of a rate hike by September surging as high as 70% at one point, according to trader positioning. Such dynamics created a challenging environment for assets like gold, which often thrive in lower rate settings but can face headwinds when tightening appears on the horizon. Compounding this, other sectors told contrasting stories. Energy prices, particularly oil, surrendered all recent gains tied to geopolitical tensions, as key maritime passages showed signs of stabilization and diplomatic progress in certain regions eased supply concerns. Meanwhile, technology equities surged anew, fueled by impressive earnings outlooks from leading semiconductor firms that reignited enthusiasm around artificial intelligence advancements. This rotation of capital away from traditional safe havens toward growth-oriented plays added further pressure, squeezing precious metals in the cross-currents of shifting investor sentiment. Against this backdrop, one prominent financial institution notably revised its longer-term outlook, stepping back from an especially bullish projection that had envisioned substantially higher levels for gold. The move amplified the narrative of a potential top being reached, with business coverage emphasizing the downside risks and cautioning participants about overexposure. Yet, as we explored through in-depth discussions with seasoned professionals across the macroeconomic landscape, a strikingly consistent perspective emerged, one that challenges the surface-level pessimism and highlights structural factors poised to support the sector over time. These conversations revealed a shared conviction that recent price action represents a healthy consolidation rather than the end of a bull cycle. Market veterans emphasized how precious metals have historically demonstrated remarkable staying power during periods of policy uncertainty, often rebounding strongly once underlying drivers reassert themselves. In this case, persistent inflation readings, even as they complicate immediate rate cut prospects, underscore the very reasons why many investors turn to gold and silver as stores of value when fiat currencies face erosion risks. The experts pointed to global debt levels, ongoing geopolitical complexities, and central bank behaviors worldwide as foundational supports that transcend short-term fluctuations. Consider the broader context of monetary policy evolution. With a new leadership transition at the central bank this period, participants are closely watching for signals on how the institution will balance its dual mandate of price stability and employment support. The inflation report has injected fresh caution, suggesting that any easing cycle could proceed more gradually than previously hoped. However, this environment also amplifies gold's appeal as a hedge against potential policy missteps or prolonged higher-for-longer scenarios. Historical patterns show that during similar inflationary phases in past decades, precious metals often outperformed once the initial shock of data releases subsided and markets adjusted their pricing. Silver's performance merits particular attention here, given its dual role as both a monetary metal and an industrial input. The recent decline reflects sensitivity to broader economic growth concerns, especially with manufacturing activity showing mixed signals globally. Yet, demand from sectors like renewable energy, electronics, and electric vehicle production continues to expand, creating a supply-demand imbalance that many analysts view as fundamentally bullish over the medium term. Unlike gold, silver's industrial applications add layers of volatility, but also potential upside catalysts as technological adoption accelerates. The week's price action near that $58 area tested key support levels, but conversations with market participants highlighted how such dips frequently precede meaningful recoveries when inventory data and fabrication needs align favorably. Turning to the mining side of the equation, industry voices stressed operational realities that often escape mainstream coverage. Exploration budgets, production costs, and geopolitical risks in key producing regions all factor into the supply equation, potentially constraining new output even as investment demand grows. Financing experts noted that while equity markets for miners have faced their own pressures, the underlying asset values in the ground remain compelling, especially with elevated prices relative to historical averages. This dynamic encourages a more measured approach to capital allocation, favoring established producers with strong balance sheets over speculative juniors in the current climate. Fund managers specializing in the metals space echoed these themes, framing the week's volatility as an opportunity for strategic positioning rather than a reason for retreat. They highlighted portfolio diversification benefits, noting how allocations to gold and silver can mitigate risks from equity market concentration in technology or energy. In an era of elevated valuations across many asset classes, precious metals offer a counterbalance, particularly when real yields and currency dynamics evolve. The consensus from these discussions painted a picture of patience paying dividends, with near-term corrections serving to shake out weak hands and set the stage for renewed momentum. Expanding on the inflation dynamics, it's worth delving deeper into what 1% truly implies for everyday economics and investment strategy. This acceleration, driven by components ranging from shelter costs to certain goods and services, signals that underlying price pressures haven't fully abated despite prior tightening efforts. For gold, this reinforces its traditional role during periods when purchasing power preservation becomes paramount. Investors scanning the horizon see parallels to earlier cycles where sustained inflation above target levels eventually drove safe haven flows, rewarding those who maintained exposure through interim drawdowns. On the rate outlook front, the brief spike in hike probabilities captured market nervousness, but also illustrated the fluidity of expectations. Trading desks and analysts monitor tools like those from futures markets to gauge sentiment shifts, yet these readings can pivot rapidly on subsequent data releases or official communications. A potential hike in September would represent a notable departure from the easing narrative that dominated earlier in the year, potentially strengthening the dollar in the short run and weighing on commodities. However, longer-term implications include heightened recession risks if policy becomes overly restrictive, a scenario where gold's defensive characteristics shine brightest. Geopolitical and energy market intersections added another layer to the week's narrative. The reopening of critical waterways and progress toward regional stability helped alleviate immediate supply fears in oil, redirecting capital flows and contributing to the risk-on sentiment that pressured metals. Yet, such developments remain fragile, with underlying tensions capable of resurfacing and reigniting safe haven demand. This interplay between energy prices, inflation, and monetary policy creates a complex web that precious metals navigate with unique advantages, often decoupling from broader risk assets during stress periods. Artificial intelligence and technology's resurgence merits examination too, as it exemplifies the capital rotation at play. Strong corporate guidance in semiconductors lifted broader indices, drawing attention and funds away from hard assets. While this dynamic explains the immediate headwinds for gold and silver, it doesn't diminish their strategic importance in well-constructed portfolios. Many experienced allocators maintain that a balanced approach incorporating both growth exposures and defensive holdings proves most effective across market regimes. The week's events served as a reminder of this timeless principle. Reflecting on the mining finance perspective, access to capital remains a key theme influencing sector performance. With interest rates elevated, junior explorers and developers face higher hurdles in funding projects, which could limit future supply growth and support prices down the line. Established operations benefit from higher realized prices, bolstering cash flows and enabling shareholder returns through dividends or buybacks. This bifurcation in the industry creates selective opportunities for investors attuned to company-specific fundamentals rather than broad price movements. Economists attuned to historical boom-bust patterns draw lessons from prior housing and commodity cycles, noting how sentiment extremes often mark inflection points. The current environment, marked by policy uncertainty and asset class rotations, echoes elements of those periods, suggesting that disciplined analysis over emotional reactions yields better outcomes. The collective input from market practitioners this week reinforced a constructive longer-term stance, even as they acknowledged the validity of short-term caution amid the data releases. As we synthesize these insights, several key themes crystallize for precious metals participants. First, volatility is inherent and often creates entry points for those with a multi-quarter horizon. Second, fundamental drivers around inflation, debt sustainability, and central bank policies provide enduring support that headlines frequently overlook in favor of immediate price action. Third, silver's industrial leverage offers asymmetric potential as green technologies and electronics demand evolve, complementing gold's monetary primacy. Looking ahead, market watchers anticipate continued data dependency with upcoming releases on employment, manufacturing, and consumer spending likely to influence rate expectations and, by extension, metals pricing. Central bank meetings will draw intense scrutiny for any shifts in forward guidance, while geopolitical developments could introduce sudden catalysts. In this landscape, maintaining a diversified perspective and focusing on quality exposures stands out as prudent guidance. The recovery in gold prices late in the week demonstrated underlying bid interest, suggesting that sellers exhausted themselves near those key levels and buyers recognized value. Technical analysts might point to support zones and moving averages as reference points, but the fundamental story carries greater weight according to the professionals engaged in these discussions. Silver, though more volatile, similarly showed resilience in holding above critical thresholds despite the broader pressures. For investors navigating this space, the message is one of informed optimism grounded in realism. Avoid knee-jerk reactions to headline-driven moves. Instead, prioritize understanding the macroeconomic mosaic and company-level strengths within the mining ecosystem. Precious metals have weathered countless cycles, emerging stronger when conditions align, and current indicators point toward eventual validation of that track record. This week's developments, while challenging on the surface, ultimately highlighted the maturity and depth of the gold and silver markets. As global uncertainties persist, from inflationary trends to technological disruptions and energy transitions, the role of these assets as portfolio stabilizers gains renewed appreciation. Participants who engage thoughtfully, staying abreast of evolving data and expert perspectives, position themselves to benefit from the opportunities that volatility unveils. In closing this inaugural episode of This Week in Focus, we invite you to reflect on how these insights apply to your own strategies. The conversations we featured underscored a prevailing view that recent price action is more pause than reversal, with structural tailwinds poised to reemerge. Stay engaged with the channel for ongoing coverage, deeper dives into specific topics, and interviews that cut through the noise. Your support and comments fuel our commitment to delivering high-quality, actionable market intelligence each week. Until next time, maintain perspective, prioritize diligence, and approach the markets with the respect they demand. This has been your guide through the gold and silver landscape. Thank you for joining us.